Let me now bring on board Sandeep Jesha, Chief Executive Officer with Sampriti Cap. Sandeep, morning. Thank you for joining us. The story of how Indian markets have moved in the month of Feb was largely decided by global liquidity and local momentum. What do you mind will influence the story of how Indian markets will move in the month of March?
Well, I guess our calendar is chock-a-block. We've already had the UP election results and the disappointment post that, which I think is broadly factored in. We were looking for the market to correct to about 5,000, 5,200, which is where we've hit day before. If you recollect, the last time I was on your show, I had mentioned that at 5,500 odd that we should take protection at higher levels. And I also mentioned that it was difficult to, mention the precise upside because of liquidity. But I think the risk is, if you look at broadly the budget, one could argue that this is in a sense the finance minister's swan song because, the 2013, obviously there's not much that the finance minister will be able to do. So this is really the last budget in which if he wants to do anything serious, whether it's by way of implementing reform in terms of cutting subsidies and various other things. I'm not saying that all reform should happen in the budget. That's not necessary. But in terms of fiscal prudence, fiscal discipline, as well as showing some imagination and innovation, I think there is a fair amount of scope in the budget. But I think what I'm concerned about is the fact that the budget date was postponed to after the UP elections, which to my mind suggests that I think politics is going to play a bigger role in the budget formation than pure economics. So from that perspective, I think that if there is a risk that the RBI does not cut rates but simply cut CRR just before the budget. And I think if the budget is disappointing and if we find that, subsidies continue to be high, there are a lot of dole-outs and populism, and the fiscal deficit for the next year also stays above 5%, then there is a risk that we could sell off below 5,000 as well. Depending upon, how negative it is in terms of the numbers, we could even go down to 46 to 4,800. But I don't think we should break the bear market low which we made in December.
So in the near term, essentially, you are not a bull, you are a bear.
Well, I think it's, the markets may bounce back from here pre-budget because we've already fallen. But I think that the risk, but what I'm saying is that it all depends on the budget. So, I don't know for sure what will happen to the budget, but I can only highlight the risks that might happen in the budget. So I think at this stage, if the market rallies at pre-budget, you may again want to buy some protection. I think that's the way that I would put it.
So Sandeep, stick your neck out, and given the parameters that the government is having to work with, would it be a populist budget or a reformist budget?
Well, like I said, I'm hoping, and my heart is saying, let's hope that this time it is a reformist budget, and my head tells me that no, it's more likely to be populistic, simply because they postponed the date of the UP election, of the budget post the UP election result. There was absolutely no need to do that. What does the budget have to do with, the budget is a statement of finances for the next fiscal year. What does it have to do with the UP election results? It has absolutely nothing. Maybe they may have wanted to have the budget after the last day of voting. Perhaps, yes. Okay, that's understandable. But why wait for the UP election result? It's simply that more than anything else. But if you look at the fact, if you were to look at it from another perspective, so that's my conclusion. But I think if you want to look at it from a third point of view, I think you could argue that, the government is in we're in a corner, things are getting worse, and the government needs to do something. So perhaps there is a chance that he may try and balance the populism with the reformist side, but the bet is more towards the populist side.
Between credit policy and union budget, which to your mind will be a big market moving event?
I think both are important and significant. I think the only point is that I think it's what happens in the event which will make them earth-shattering. If, for example, we find that we actually see an interest rate cut in the credit policy, which is not the base case expectation, then that would make that more significant. And if in the budget we actually saw some attempt at reform, not the kind of reform, where there is opposition which can be done outside the budget, but there are so many things which can be done inside the budget. So it really depends on the nature of the event which will determine which is more important. It's not them per se. It really depends on if the RBI simply, cuts CRR by 50 bips and there's nothing on interest rates, well, there's going to be no change. Similarly, but the budget, in fact, if it's populistic, there's a problem. If it's reformist, it's good. So in that sense, perhaps you could argue that the budget might be a little bit more important than the credit policy.
Sandeep Jesha, crude prices are at a fresh 9-month high. So on paper, if crude prices stay where they are, it is impossible to make a case for going long on India.
I agree that, it makes things so much more difficult, especially with, it's interesting if you just, lean back and just take a look, in the US when we saw QE1, we saw everything rally, equities, all commodities, everything did well. Then we had QE2. Once we had QE2, emerging markets corrected, commodities went up, developed markets continued to hold up. Now, similarly with LTRO1, we saw that, on the developed market side, we saw a huge amount of rally happening there. We saw commodities rally briefly, but not significantly. But with LTRO2, commodities have rallied significantly, perhaps more of crude. But on the flip side, you had, negative numbers coming from China. So putting all of this put together, and plus the fact that the rupees again, fallen from 48 to 50. So I agree that it makes the investment case much more difficult because it's not just crude, it's also the rupee. And I think of a rising crude along with a falling rupee is a double whammy that is going to be very difficult for us, and it will certainly cap the upside, and it will certainly make the finance minister's job that much more difficult, because I think you've got to see some reform on the oil sector side, or we've got to have some clarity. I think without that, the crude rallies will always, cap the upside for the Indian market.
Sandeep Jesha, what is weighing Mahindra and Mahindra down? Tractor sales or possibility of a price hike in diesel cars?
Well, both, of course. But, I think if you recall all of last year, M&M had outperformed significantly because the rural economy was holding up very well. In fact, we also saw a time when we actually saw that not just utility vehicles, but even heavy commercial vehicles were doing very well, which is very unusual for an economic slowdown or for a bear market. But I think, if you look at what's happening to the rural economy, fertilizer sales are down, two-wheeler sales growth has been coming off. There are concerns about huge inventory buildup. Tractor sales have plummeted. So from what has largely happened here is that even though the crop has been good last year, support prices have not held up. Government procurement of crops has not been good. So, it's ultimately a question of volume multiplied by price, right? Even if volume is up but price is down significantly, there isn't a substantial increase in rural income. And that's having an impact on M&M. And obviously, case of having already outperformed, not much upside left from that perspective. So I think that's really the reason why.
Sandeep Jesha, have you taken a look at MCX and does it interest you?
Oh, certainly. I think obviously this is the premier commodity exchange. I think they've built a very good platform in terms of, trading global commodities. That has actually been the USP of this exchange. And they've actually managed to have, market share in some of these global commodities in the top 3-5 positions. So I think very broadly, I think this is something that which could even trade at about close to even 25 times. That's where I think the upside is. I'm not saying that that might be a sustainable valuation, but it can certainly trade at 25 times. I think which could give you a price of close to 1800. This is not to say that that's going to happen today or tomorrow, but I think that's where I think the broad upside is. So it's a very simple story. I mean, you don't need, it's not too complicated, right? I mean, it's so easy to understand. All you need to track is actually the commodity volumes that are happening on this exchange, and and see the growth there. I mean, it's so in that sense, it's a relatively easy, simple story to track, and those kind of stories are the ones that actually help you make money. Yeah,
there is certainly some degree of scarcity premium here. So what's the bottom line, Sandeep Jesha? For those who got allocated, or those who got shares at 1032, you would advise those retail investors not to sell on day one?
Well, I think it really depends on your perspective. If you're a trader and if you get more than 1500, you might flip. But if you're a longer-term investor, I think this is something that could compound at 20% for the next maybe decade or so. It's a possibility. I'm not saying it's going to happen, but it's a possibility. As long as there are no curbs on commodities, you don't find anything adverse on the tax structure, and globally there are no issues in terms of trading these commodities in India as well. So as long as the environment is all right, I think this is a stock that you could own for the next 5 to 10 years as well.
But what price are you a buyer in your institutional portfolio, in your personal portfolio?
Well, I think one would be more comfortable buying it between 14 to 1500, not above that, because the upside, as I mentioned, if you were to say that it could trade at 25 times next year earnings, that would give you an upside of about 1800. So, you need some margin of safety. So 14 to 1500, I think, is a price which one is comfortable with.